If you have spent any time consuming financial content online, you have almost certainly been told some version of the same advice. But here is what that advice leaves out entirely. The people with the most money in the world are not following it. Not primarily. The investment playbook used by individuals with $50 million or more in investable assets looks fundamentally different from what gets taught in personal finance content, recommended by mainstream financial advisors, and discussed in the financial media that most people consume. In 2023, a comprehensive study analyzed the actual portfolio compositions of ultra-high net worth individuals defined as people with more than $30 million in investable assets. Less than 30% of these portfolios were in publicly traded stocks and bonds. Less than 30%. The asset class that dominates the conversation in personal finance content, the one that gets the most attention, the most analysis, and the most advice, represents less than a third of how the wealthiest investors in the world actually allocate their capital. The remaining 70% was spread across what the investment industry groups together under the label of alternative investments. The first reason is what institutional investors call the illiquidity premium. Private investments do not have this liquidity when you commit capital to a private equity fund, a private real estate investment, or a direct business stake. You are typically committing it for 5 to 10 years with limited ability to exit early. The market compensates investors for accepting that constraint. Historically, private investments have generated returns approximately 2 to 4% higher annually than comparable public market investments. The second reason the ultra-wealthy allocate heavily to alternatives is non-correlation. When the public stock market experiences a significant decline, as it does periodically and unpredictably, virtually every publicly traded asset tends to decline with it. Private assets behave differently. The value of a farmland investment does not move because the S&P 500 had a bad week. The rental income from a properly managed real estate investment does not stop because public market investors are panicking. These assets are non-correlated with public markets not because they are inherently safer, but because their value is determined by different factors entirely. A portfolio that combines public market investments with genuinely non-correlated private investments does not just potentially earn higher returns. The wealthy are not just chasing higher returns with their alternative allocations. They are building portfolios that hold their value better when everything else is falling apart. The third reason is access to opportunities that simply do not exist in public markets.